Yeah, Randall's kind of dope.
Yeah.
He plays a vital role, by the way, in Mosh's work.
Oh, is he?
Yeah, he's back, baby.
Yeah, let's go.
All right, so the VIX measures how nervous or uncertain investors are about the near future. If the investors expect a lot of turbulence or trouble, like during an election or a crisis, the VIX shoots up because more people are buying options to protect themselves from big market swings.
Right, and that's the part about it I want to get into after we read this.
We will. Don't worry, Sugar Plum.
Mm-hmm.
Think of it as everyone grabbing an umbrella before a storm, right? That's the best kind of reference I could, right? What do? You grab an umbrella. What's an umbrella? A very safe investment for the long term. That's the bonds. That's the options.
That's
right?
the options, yeah.
So even if the sky just looks a little cloudy, they're like, shit, I should bring an umbrella just in case. You don't know what's going to happen.
Mm-hmm.
That's kind of what the VIX is. When the VIX is low, it means that the market is calm. Everyone's Gucci.
Yeah.
Copacetic.
Yeah.
They're dope. Is there another hip word around that you can think of that I can't?
Yeah.
Fly.
That's not.
It's lit.
That's also out.
Is that fire?
No, I don't think that's a good one too.
Okay, how about it's cracking?
No, dude, these are not modern terms.
I'm
bro.
okay with it. But we gotta.
I think skibbity is one of them.
Yeah, bro.
Skibbity, bro.
Yes.
Is that the usage for that?
I don't know why they say, bro. Adam's saying all this shit now. I'm
yeah,
like,
and it makes you
stop.
feel really outdated, right?
No. So I found the trick. So when I don't know if Carter's saying it yet, but when he does, when and if he does say it, you know what the trick is? I just abuse it at home. I start saying it all, and then it's no longer cool anymore. Dad's saying it.
What are you saying? This
I'll just literally walk around and be like, skibbity, skibbity, skibbity. And then he's just like, come on, man.
I
Stop.
thought you were having a seizure when you were doing that. Oh, man. All right. Well, and when people aren't worried about the big surprises, guess what? The market, it has a swing. It gets high. And people start to worry. So what happens? It's a sign that uncertainty or fear is in the air, hence the name fear meter or fear gauge, right?
Mm-hmm.
And markets could get a little choppy. I was going to think about a boat reference here, but I was like, you know what? That's a little too cliche. Around events like elections and major policy announcements, also like wars, for example, the VIX tends to spike as people hedge their bets in case things don't go as expected.
Right. Exactly.
So we're going to use the VIX in a couple scenarios historically to tell you where the market stands right now from a quantifiable perception. Consumer sentiment's a thing. And I understand there's polls for this, but I don't like it.
But this is a very good measure because the fact that they're using actual options data, right? Because people are putting their money where their mouth is, right?
That's right.
So they're actually saying, okay, if you put in a call option, right, you're basically buying a contract to, buy the stock on the way up, right? If you put in what they call a put option,
buy it on the way down.
You're able to sell it on the way down to protect yourself from getting too low, right?
Yeah, so the way I usually tell people, if you call somebody, you want them. If you put them down, you don't want them.
Yeah, you don't want them. Exactly, right? Now, you might be wondering to yourself, okay, then if I'm going to make an investment, why don't I just always buy put options just in case shit goes wrong? Well, there's an expiration to these things.
And
right?
there's a cost for that expiration.
There's a cost, right? And if it does not go down, then you lose out on that premium you paid for that put option contract.
But put and call options are a good indication where people think the market's going.
Yes.
Right? So if people think, oh my God, the market's going down, they're buying all these put options, and they're seeing this action increase, that's because the market is betting the market's going to go the other way, right? And when I say the market, I mean people who are buying stock are betting the market's going to go the other way.
And why you can rely on this data is like savvy investors that use this,
not us, obviously, not savvy.
But investors that use this as a broader investment strategy, they're only going to buy the stuff if they truly believe that something's going to happen or to maybe just hedge their bet a little bit.
Yeah.
Right? So that's why out of all the consumer sentiment stuff, this is one of my favorites.
Look at you. We're just aligned.
Aligned, baby.
Soulmates.
Blessed.
You're my Randall.
Hashtag blessed.
All right, so we're going to focus on a couple dates here. 2016 and 2008 and 2016 or 2008 and 2020. I can't remember what I put in the notes.
This is 2016 and 2020.
I don't know. I put them down there later on. We're going to talk about two different election periods with that coincide with recessionary economies. Oh, it was 2008, 2020. Those are the two dates that I chose, but you can pick any of them. What we're going to do is we're going to talk a little bit more about the VIX, and then we're going to get into those examples, and then we got some chart work. Right? All right, so the VIX index has recently risen slightly. Okay, not a lot, slightly, signaling increased investor concern about political and economic uncertainty leading up to November 5th. I look at this slight increase as not significant, and I know people are like, oh, you said that, hey, it's going up, it's bad. People expect storms, rain clouds, all that stuff. That's because people are betting on the market. If they were betting in a sizable way, I think there'd be more movement than what we're seeing. So, grain of salt here. Okay.
I think some of this is always going to be around anytime there is.
Yeah,
an election,
people know an event's coming up.
Yeah.
So they're trying to make money on the event, right? They're trying to bet one way or the other on the event.
I think I saw a statistic too that so far for all of October, the S&P has not gone up or down 1% for the whole month.
Really, I don't know that. You sure?
Yeah, I think I want to say it. That's what I read today. Was it S&P or the Dow? Yeah, and it was literally said like not 1% up or down because it's everyone's kind of waiting to see what happens.
It's probably the Dow. Is my
probably
guess.
The Dow. Yeah, maybe it's the Dow.
Anyway, while Haroon's probably looking that up. In both the 2016 and 2020 elections, the VIX index rose sharply in the months leading up to the election day, reflecting market anxiety over policy shifts and potential contested outcomes. In 2016, it ranged between 10 and 15% up, while in 2020, it spiked between 25 and 40% due to the election, uncertainties, and pandemic disruptions. And we're going to do a case study on 2020 here in a little bit. October tends to show peak volatility during election years, with the VIX generally dropping post-election if results are decisive.
It was the Dow, by the way.
Yeah, okay, I figured. Yeah.
Sorry.
See, I know a little bit about what we're doing here.
Yeah.
I have a little bit of financial literacy here. So through the, thank you, everyone, if you could scroll up. Thank you. Through the 2000 and 2020 elections, we saw 2000 and 2020 elections saw elevated volatility persist due to delayed outcomes and policy uncertainties. So if somebody's getting in the office and you're worried about what they're going to do to the economy, the VIX is going to stay high because there's that fear. If the election goes as you think it's going to go, and most people are like, I kind of expected that, then the VIX is going to drop because they're like, okay, we've made our bets, we won or lost, we're not so uncertain.
Right, so it's more stable.
Yeah, so commonly kind of described. As the 2024 election approaches, rising VIX levels again highlight market caution, with a likely decline in volatility expected once clarity on policy direction emerges. Chris, what the actual fuck does that mean? Did I put that there, or did you put it there?
I did not put that there.
You wrote that.
Did I really?
Yeah.
I talk to myself a lot, apparently.
What the fuck does that actually mean? Chris, break it down for the masses.
Oh, I know I put it there because I actually put down the colloquial answer below it. Sorry.
Oh.
I read.
See, you're not giving yourself credit. You structured this very well.
When you walked to my office today,
yeah.
I just wrote the paragraph below here, and I forgot to take the part out. Sorry. So colloquially, this means the stock market tends to get really jumpy around election time. Investors hate uncertainty, and during elections, they don't know what the policies will come, what will come next, and who will be in charge. So they start hedging their bets, buying protective options and futures, which send the VIX index, the market's fear gauge, higher. This pattern was clear in both 2016 and 2020, especially in 2020, when the added chaos of the pandemic made things even shakier. Obviously, it was a pretty volatile time in the market. We didn't know what was going to happen. Right. Not knowing is a key uncertainty and volatility indicator, for the record.
Right.
The market usually calms down after the election, but when results are delayed or disputed, like, I don't know, somebody saying that they shouldn't have won presidential campaigns, for example, things they don't calm down all the time. So because there's uncertainty, it could cause trouble moving forward. So like in 2000 and 2020, the nervousness sticks around longer. Right now, heading into the 2024 election, we're already seeing signs of this jumpiness as investors prepare for any surprises come election day.
So at this point, it's a coin flip. So would it really be a surprise